Hello, everybody. Welcome back to Retirement Clarity Radio. I am your host, Scott Newhouse. Thank you so much for being with me. We are in the midst of baseball season. I'm a big Dodger fan, so I've got my little Dodger Heads t-shirt. So one of my friends, Jeff, he runs a YouTube channel called Dodger Heads. So if you just type that in on YouTube, if you're a baseball fan, you're a Dodger fan, he's got some great commentary. And I designed this shirt, by the way. Doesn't that look good? So it's like bobbleheads with Dodgers across the board. I don't know. I'm not going to get too close to the screen, but anyways, I designed the shirt. Very, very proud of that, if I do say so myself. So I wanted to record this video because we are going through a lot in terms of the market so far in 2022. A few months ago, I recorded a podcast video, and it was called 5 Tips for Navigating Down Markets. So that podcast, that video, that was really like mental things that you need to remember, kind of like encouragement about contextualizing how often we're going to see down markets and how you should think through going through a down market. Today's podcast video is going to be different. It's going to be 6 tangible, actionable things that you can do today for your portfolio, for your investments, to shore everything up in a down market. So it's a little, the title's kind of similar, but it's completely different content, because I don't want to tell you the same thing, 2 months in a row, unless you really need to hear it. But anyways, let's just jump right into it. So 6 things that we need to do in a bear market, and it's geared for people close to or in retirement. The very first thing that we need to do is we need to think about rebalancing your accounts. And so what that simply means is, if let's say you decide that you want to have an asset allocation of 50% stocks and 50% bonds, and the stock market goes down a lot while the bond market's flat, well, then it might be a good idea for you to take some of the bonds, which are flat, and put them into your stock portfolio. And I hope that kind of makes sense. It's kind of like selling high and buying low, because you're selling something that has either stayed flat or has gone up a little bit. You're selling something like that, and then you're buying into something that's fallen down a lot. And what I want to do right now is I actually want to kind of go through a sample portfolio about how this would actually work and why it would be beneficial. And so what we're going to do to illustrate that is, and if you're listening on the podcast, you should probably jump on YouTube so you can see all of this. I'm going to be sharing my screen right now, and we're going to look at the Vanguard Total Bond Market ETF, and the ticker symbol for that is BND. And then we're also going to be looking at VTI, ticker symbol VTI. That's the Vanguard Total Stock Market ETF. And so the Vanguard Total Stock Market ETF, that comprises the entirety of the U.S. market, large, medium, small size companies all across the U.S. And then the Vanguard Total Bond Market is basically an exposure to U.S. bonds, and it's a wide variety of U.S. bonds. Let me see if I can pull it up here just before we get started. So yeah, the ticker symbol BND, Vanguard Total Bond Market, has around 10,000 different bonds that it's going to own, and VTI has around 4,124 different stocks that it owns inside the U.S. And that's basically the entirety of the U.S. market. So what I want to do is I want to illustrate how rebalancing would work and why it would be beneficial in bear markets, in down markets. So what I'm going to do to be able to do that is I'm going to go to a website called portfoliovisualizer.com. And again, you should see it on the video, and I'll try and put it in the show notes. But what I'm going to do is I'm going to go through 3 different bear markets, 3 different market downturns that we've had in the last 15 years. So I'm going to do 2008, I'm going to do 2020, onset of COVID, and then I'm going to do 2022, what we're living through right now. So let's say we start the year in 2008 and we end the year in 2008. So that's what the numbers that we're going to run. Let's say we start off with $100,000 as our initial amount. We'll just throw the whole thing in. Let's turn the rebalancing off because I just want to see this. And then what we're going to do for this portfolio and these numbers that we're running is we're just going to split it 50-50. So 50% is going to be in the total bond market ETF, and then 50% is going to be in the total stock market ETF. Now, and I might have said this in previous videos and podcasts, honestly, I think 50-50 is a little conservative for my taste. If you're in retirement, if you're comfortable and you're the decision maker, and it's your money, and you got to be able to sleep well at night. But if you're comfortable, I'd probably encourage you to get a little more stock in there than just 50% in stock. But just for simplicity for this video, we're going to do 50-50 bond and stock portfolio. So 50% in each. And then on my screen, I'm just clicking Analyze the Portfolio. And so from the start of 2008 until the end of 2008, you started off with $100,000. You would end up with $84,941. So you lost a little over $15,000. That definitely hurts. But what I want to show you, and this should be encouraging, is the annual returns that we're going to show right now. And so again, if you're listening on the podcast, the Vanguard Total Bond Market throughout 2008, from January 1, 2008 until December 31, 2008, the bond market portion of your portfolio got a 6.86% return. That's during the Great Recession. That's during like an economic calamity. And so that is really encouraging that your bonds held up so well during that much uncertainty. Now, your Vanguard Total Stock Market Index, this is your stock fund, all the U.S. companies that it owns, it was down 36.98%. So it was down 37%. That's rough. We all know that's rough. It's not easy to see that on the screen. It's not easy to see that in your accounts. And I should also note before we move on that the downtrend did continue all the way until March. We hit bottom in the stock market in March of 2009, and then we started our bull market run pretty much until this year. So it did go down a little bit more after this, but I just want to make this simple and just go through 2008. So going back to rebalancing, let's actually, one more thing on 2008. Let's look at these monthly returns. So we start off the stock market in 2008. In January, the stock market was down 6.17%, then it was down 2.5%, then it was down another percentage point. During those 3 months, January, February, and March, your bond portfolio was actually up. And so when I'm talking about rebalancing, what I want you to do, or at least think about, and it's not necessarily a requirement, but it's definitely something for you to think about, is does it make sense for me to sell something that's even or up, which might be your bonds, and sell some of that and then buy into something that's down, and it's down pretty significantly. Now, I do want to point out one more thing, and this is, what would that be? October. So October was the worst month in 2008. The stock market, so your stock portion of your portfolio, is down 17.5%. Big drop. Now, and this should be good news, your bond portfolio was only down 3%. Now, a 3% drop in 1 month for bonds, yeah, that is a lot. I'm not gonna dispel, I'm not gonna argue with that. But it's still down, 14%, 14.5% less than your stock portfolio. So what I want you to do is I want you to think about, are my bonds performing as poorly as my stock portfolio? If they're not, I want you to think about, hey, do I have the ability, do I have the willingness to sell some of my bonds and buy into stocks when stocks are at a pretty low level and my bonds have stayed flat? Let me take a little sip of water here. Now, I want to also show you what happened during 2020. So this was 2008, Great Recession. Let's go into 2020 and see what happened to our stock and our bond portfolio. And then next, we're going to have to go into 2022, which is not going to be as fun, I got to admit. So we're going to keep everything at 50-50, 50% bonds, 50% stocks, and we're going to analyze the portfolio. Okay, so in 2020, if we had $100,000 to start off in January, at the end of the year with the 50-50 portfolio, we would be up to $114,371 is what we would have at the end of the year. Now, as you remember, January and February were fine, and then March is when things really went bad in terms of COVID, in terms of people being really scared, in terms of the stock market really falling down a lot. So let's go into let's see the annual returns. Well, I'll just do the annual returns really quick. So in 2020, your bond market fund would have gotten you a 7.71% rate of return. That's fantastic for bonds historically. And then your stock market fund would have gotten you 21%. That's unbelievable as well. So overall, it would have been a really good year, but man, March and April would have been tough and scary, and you would have had to hold on. And hey, if you had the chance to rebalance in March, it would have been even better. And let's talk about why. So the first 3 months of 2020, your bond market fund was up 1.98%. Then it was up 1.67%, and then in March it did go down, but it only went down 1.43%, and that's when everything was going really, really poorly with the stock market. So in January for the stock market, it was down 0.06%, then in February it was down 8%, and then at the end of March it was down 13.91%. So it was down 14% that month. If I recall correctly, from top to bottom, the stock market during COVID was down 35%. And so this doesn't reflect it because I think there's a little bit of a bounce after the initial scare in mid-March. But still, I mean, it's down. It's basically even in January, then it's down 8% in February, then 14% in March. At the same time, your bond portfolio is up on the year in January, February, and March. So in March of 2020, this would have provided you a great opportunity for you to sell just a little bit. Don't go crazy. You're not trying to get 100% stocks, but sell a little bit of your bonds while they are flat, or actually while they're up a little bit, and then put that extra money that you just got from your sale and put it into the stock market when the stock market's down 15, 20, 25%. So that's the general that's the general strategy there. It's simple in terms of explaining it. It's a little tougher to do because there's emotions involved, and I absolutely admit that. And so that is what would have happened in 2008 and in 2020. Your bond market performed really well during these bear markets, during these corrections, while the stock market was falling down and down and down. And obviously the stock market recovered in both of those instances. But if you could have sold a little bit of your bonds, bought some stocks, it would have been a really good move for you overall. Now, here's the downside though, and I told you this wasn't going to be pretty. I don't love talking about this. In 2022, bond market has not performed very well at all. And before I get into that, actually, let's just go through it. Yes, so starting in January 1 of 2022 up until today, and I'm recording on May 11th of 2022, of course, and we'll stick with the 50-50 portfolio. So far, if you would have started off in January with $100,000, right now you would end up with $88,186. So you would have lost a little over $11,000 just so far this year. So obviously that's not great. We've had a tough year so far, and let's see if we can do the annual returns. Yeah, and so the annual returns year to date, and this is what's so interesting, and this is what's so different than 2008 and 2020, is that your bond portfolio, the same Vanguard Total Bond Market Fund that we were looking at earlier, so far year to date, it's down 9.58%. And your stock market fund, Vanguard Total Stock Market Fund, is down 14.04% year to date. Now, what's so interesting about this, and you guys could have already probably picked up on it, was that in 2008 and in 2020 during COVID, your bond fund was doing well. It was actually up a little bit, And that's typically, I should also add, that's typically the norm with your bond funds. Your bond funds are typically going to be a little more stable and not as correlated to the stock market when the stock market's falling precipitously. Unfortunately for us, for everyone, in 2022, our bond portfolio is down, and it's honestly almost down as much as your stock portfolio. And the reason why I mention this is that it made a lot of sense for you to rebalance from bonds into stocks back in 2008 as well as in 2020. Right now, gotta be honest with you, it just doesn't make as much sense. You still could do it, but you're not going to get the bang for your buck that you would have in 2008 or you would have in 2020 because bonds are down so much. Now, I do also want to add, and I might do a separate video on this, and this is coming from the Wall Street Journal. Again, if you can see my video, it's very helpful. But Wall Street Journal says this is the worst bond market since 1842, but there's good news. And again, I'm going to do a separate video on that, but the reality is in 2022 so far, the rebalancing it's not as easy for us to do from bonds to stocks as it would be in a quote-unquote normal bear market, a normal correction market, and that's because our bonds are just getting hit so badly. But you still potentially could rebalance, because what I want you to do is I want you to see, is there anything in your portfolio that's actually performing well? Is there anything in your portfolio that is uncorrelated to, the general U.S. stock market that maybe might have an oversized position right now? You look at it and you say, hey, maybe I trim this position a little bit since it's performing really well, and I buy in on some kind of stock fund while it's pretty low. And so that still could be a potential good idea. I just don't think the bond idea, I don't think there's as much runway for us to rebalance right now as there has been in the past. And so that's the downside of what we're going through with the bond market and the stock market both being down almost at the same levels so far in 2022. But that is still the first thing that you should do in this bear market, in this correction that we're going through. See if you can rebalance anything that's performing well, maybe up, maybe even, and put it into something that's not performing all that well. The second thing, and this point's going to be, my second point's going to be much shorter, which is don't you dare sell your stocks. Please, whatever you do, do not sell your stocks. If you really need that money next month or later on this year, I really hope that you have some other avenue that you can get that money, get that cash that you need for whatever purchase you're doing, and hold on to sell your stocks. The last thing we absolutely want to do, is sell when the stock market is down 15% so far year to date. And some of your investments, that's the total U.S. stock market that's down 14% year to date. Some of your investments might be down more than that. The S&P 500, which tracks the 500 largest companies inside the U.S., that's down around 17.5%. So some of you might have that. Actually work with and talk to a lot of people who own that fund. It's a great fund. Nothing wrong with the S&P 500, but it's down a little bit more than the total U.S. market is so far this year. Please, 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 if you can hold on, just hold on. It's going to recover. I'm not sure when, but it will recover. Don't sell your stocks right now. That's my second tip for you in terms of navigating this bear market. My third point that I want to give to you is, if you have extra cash beyond your emergency fund, I don't want you to touch that, but beyond your emergency fund, if you have extra cash, it is a great time to potentially add to stocks. And so I'm sharing my screen again. Let me take another sip of water. Sharing my screen about some research that LPL did with Ned Davis and FactSet. Want to give them full credit. I did not make this graphic, but I did find it from them. It's fantastic. From my counting on this, since 1980, what they've done is they've calculated around 25 different instances when we've had a market correction of over 10%. So top to bottom, the stock market has fallen over 10% since 1980. And I think it's around, I think I did my counting correctly, but it's around 25 different instances that this has happened. Now, the average correction return, i.e. the average drawdown that we have from top to bottom, has been 18.8%. And again, here in the U.S., the total U.S. stock market is down 14%, but the S&P 500, which is what this tracks, the S&P 500 so far this year is down around it's down around 17.5%, 17.5 to 18%, depending on now what time of the day you look at it. So my point here is that we're almost at that average correction return. We're almost there. Now it absolutely could go further south from where it is right now. So I'm making no promises on that at all. But what I want you to look at, especially if you're watching on YouTube, is look at the 1 year return after it hits the lows. And again, no one knows exactly when it's going to hit the low. But the 1 year return after we hit the lows is 24.8%. And the 2-year return after we hit the lows in a market, in a down market, in a correction economy is 37.4%. So if you can start investing when we're going through these 15 to 20 to 25% drop downs, which is exactly what we're going through now, if you can stomach having some extra cash put into the stock market at this time, your average 1-year return, again, no guarantees, but the average 1-year return has been 24.8%. The average 2-year return has been 37.4%. That's absolutely phenomenal. And what that tells me is that when we're down 15% plus, that's the best time to invest. It's the absolute best time to invest. Now, if you've got, I don't know, let's say you've got $10,000 beyond your emergency fund that you're able to put in the stock market and you're able to not touch for, 3 to 5 to 10 years, Maybe you want to put 1/3 in right now and then see if we drop another 5 or 10% and then do 1/3 and then do another 1/3 after that. I'm actually fine with that. Some financial planners would not like that. Or you can put it all in at once. I think that's fine as well because we don't know when the recovery is going to happen. But boy, I have a lot of confidence that a recovery will happen. And if you have the stomach to invest right now outside of your emergency fund, it is a great time to put some money in the market and get it going and working for you. You could see some really good returns in the next few years if you're able to do that. That is my third tip. My fourth tip, if you're using your portfolio to generate a retirement income for you right now and you're getting really nervous, I totally understand that. I want you to think about if you would be able to tighten your belt, if you would be able to cut your expenses from, let's say, $4,000 a month to $3,500 a month. And what I want you to think about is, how much is this going to affect me on a personal level? One, if you are selling some of your shares, because our bond and our stocks are both down right now, if you're selling too many of your shares right now in these down markets, are you going to be okay with that? Is that going to feel well with you? If it's not, I totally understand that. It might be a good time for you to think about, do I either sell less or do I not sell anything and see if I have some other sources of income or other sources of cash that I could use while we wait for everything to recover? Now, what you might be asking me is, hey, Scott, how long do I need to tighten my belt? How long do I need to lower or pause the distributions I take from my investments? Fantastic question. Obviously, I don't know the answer, but we can look back into history and just see what's happened historically, which is what we've been doing all this video. To do that, I'm going to go to a blog from a fellow financial planner, a great guy. I've emailed with him a couple times. Really nice guy. His name's Ben Carlson, and he's got a blog called A Wealth of Common Sense. So full credit to Ben. Thank you for putting this together. He's got a great picture there. Okay, so what Ben has done is he's put together a chart showing the S&P 500 bear market since 1950. And there's a lot of information here, but it's peak to trough, so top to bottom, the percent decline, and then he has the number of days that the bear market has lasted from go to the top to the bottom. And I'm not going to go through everything. Obviously, if you want to look at this, you can find it on his website. You can pause this video and just look at it. But the average bear market from top to bottom, it took on average, and there's some long days in here, it took an average of 338 days. Now, I just want to point out a couple of these, which is COVID from the top of February of 2020 until the bottom of March of 2020. So in that COVID period, it only lasted 33 days. From top to bottom, we went down 33% in 33 days. That's astonishing. That is so quick. And you can look at this chart. I mean, some of these other charts have 30 or 20% declines, but it takes hundreds of days for it to get there. So I just think that's interesting that during COVID, that just happened so quickly. On the inverse side, or on the other side of this chart, it has the break even of, once we hit bottom, how long does it take us to get back to even from where we were at the beginning? Hope that makes sense. So COVID was actually, the COVID recovery was actually pretty quick. It only took us 6 months, 181 days. And so let's just go back to the averages here because I've got to be fair. Bear market since 1950 from top to bottom on or the average number of days it took is 338 days. So almost a whole year. So these bear markets can last a long time. And then the average break-even day, the average time that it took to recover was 603 days, so 1.7 years. That's a long time. I do gotta say, there's 3 instances on this chart where it took over 1,000 days. So one of these instances, it took 2,000 days to break even. 2 other instances, it took 1,480 days to break even. Another instance, it took 1,694 days to break even. That's extraordinarily long. Can it happen again? Absolutely. So please do not take this. Don't take anything I'm saying here as a guarantee. I'm just trying to give you, some historical context to everything that we're going through and what we could potentially go through in the future. So when you're thinking, hey, how long would I potentially need to tighten my belt? It could be a while. And so again, though, if you're being, I guess what I'm trying to say is if you're being proactive instead of reactive, and if you're tightening your belt or seeing what expenses you can get rid of right now, if things are tight, and you've got to figure out if things are tight or if you're going to be fine selling, shares at a 15-20% loss, you've got to figure that out on your own, or work with the financial planner and just make sure you understand like the implications of everything. But I want you to think about how long this bear market could last to go from top to bottom, as well as how long it could take for things to recover. And again, if you're worried that this might last longer than you would like, and then that your portfolio could justify, then we really got to think about tightening our belts, just so we can elongate your portfolio, and so that we're not selling too much at a 15 to 20% drop. Okay, so that is my 4th point that I want to point out. The next 2 are going to be really quick. The 5th tip that I have for you to do in a down market correction is cut your expense ratios. A lot of people that I work with still to this day, a lot of people that reach out to me to get, to talk to me to see if it's a good fit for us to work together, they have actively managed funds. And it's obviously it's gone the way of everyone should be in passive, low-cost index funds, but there's still a lot of people out there. There's a lot of folks out there, maybe some folks out there listening, who are in actively managed funds where they're charging you expense ratios of 0.8%, 1%, 1.2%, and frankly, they may not be outperforming the market. Now, if they're really fantastic financial managers, then they could be worth the cost, but frankly, 90% plus of professional money managers, they're not able to outpace the S&P 500. Now, if you can find the next Warren Buffett, who's going to get you 20% returns over the next, 50 to 60 years, which is what he's done, hey, I'll pay 2% for that. No, I mean, you're not going to be able to find that person. And if you do, you should definitely put it in the comments down below so we can all jump in and benefit from that person's expertise. But so my 5th tip for you in this market correction is see if you have any expense ratios that are way out of line, way higher than what you need to be paying. Let's see if we can cut those. And that's a net boost to your portfolio just there. And then you do also need to think about the tax implications there. So if this is a taxable brokerage account, just watch out, be careful, know what you're doing, get help if you're not sure what you're doing. Obviously, in our retirement accounts, there's no tax implications when we buy and sell. There's only a tax implication when we take it out of the account in certain types of accounts. So just be careful what you're doing on the taxes there, especially if it's a non-retirement account. But I really think you've got to look at cutting your expense ratio. And then the 6th thing that you should do during a bear market, turn off CNBC, turn off Bloomberg, turn off the Wall Street Journal, and stop checking your accounts daily and stop checking your accounts weekly. It's a tough time. It's a tough time for everyone, whether you're just normal folk out there, whether you're working with a financial planner, whether you're a financial planner yourself. No one likes seeing markets down 15, 20, 25%. And it could honestly get worse from the levels that we're at right now. But if you're fully invested, if you know you don't really have much more cash, or you've already deployed the extra cash that you have above your emergency fund, and your asset allocation is set, I really don't see why you need to be checking your accounts so frequently. At most, I would check it once a month. And honestly, if you can do it maybe every 6 weeks or every 2 months, I think that's even better. We will get through this. I don't know when, but if you do these 6 things, I think it's going to give you the chance to boost your portfolio, put you more at ease knowing that you've taken control of what you can control, which is all we can do in life. We can control what we can control, and we can't control the markets. But historically, you keep that low-cost, well-diversified investment portfolio, you're going to turn out all right. So I hope this is helpful. If there's anything I can do to help you navigate this, put it in the comments down below. If you do like this video, please like and subscribe. I will see you next time. Bye.